Thanks for clicking. Some Canadian homeowners have seen their mortgages extended to 70, 80, or even 90 years. This according to a new interview conducted by Bloomberg. According to the interview with Ratesdotca, interest rates have risen to such an extent that some of those holders of variable rate mortgages with fixed payments are paying nothing towards their principal, basically just paying rent to the banks.
Just chipping away at that interest only. They're essentially just paying rent to the bank.
Yeah, it's a crummy system, but what are you going to do?
Yet, despite some of the confusion on display during Bloomberg's interview, which we'll get into, these extended amortizations are only being offered to existing homeowners and are not available to the public at large. So what I want to do today is go over Bloomberg's interview, taking a look at these 70, 80, and 90-year mortgages, take a look at the history of longer amortization periods in Canada and why they won't be coming to home buyers anytime soon, and then discuss some implications for the future. We have a big week coming up with Stats Canada set to release Canada's inflation numbers for the month of May early next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. On to the interview. Bloomberg conducted an interview with Victor Tran, a representative from Ratesdotca, who noted that some of his clients have seen their amortizations rise up to 90 years.
I've had many clients with amortizations that are 70, 80, even 90 years remaining in the extreme cases.
And yeah, those clients have variable rate mortgages with fixed payments. So as prime rises, as the Bank of Canada increases interest rates, the portion of their payment that goes towards principal decreases and the portion that goes towards interest increases. And when that fixed payment isn't enough to cover the interest due to the bank extends their amortization, in this case up to 70, 80, or 90 years.
Everything's cool right now. Might be some problems later.
But, says Tran, this trend may not continue for much longer, as the government might be stepping in to force the banks to demand an increase in payments.
I think it's going to start cracking down. The government regulators are going to come in and force the lenders to start working with these customers to start collecting some principal payment.
So, as we talked about before on this channel, minus the 90 years, holders of variable rate mortgages with fixed payments are seeing their amortizations increase. They're seeing their amortizations go up to 50, 60, 70, 80 years. And the banks, on direction from OSFI, may be asking for a payment increase in short order. With that said though, I just want to very briefly address some confusion over these longer amortizations, which was clearly evident on Bloomberg.
New data from Statistics Canada says at the start of this year, nearly half of all new mortgages taken out in the first quarter had amortizations longer than 30 years.
But that's just not the case. These longer amortizations that are being offered by the banks, these are for existing homeowners. And the hope, faint though it might be, is that the Bank of Canada will reverse course on interest rates in short order, and then these amortizations can go back down to normal. Once interest rates go back down, so too will the amortizations. But unfortunately, Bloomberg, one of Canada's main sources of financial news, went on.
My goodness, wouldn't a bank be reluctant to sign someone on for an amortization period of that length? I mean, the average lifespan, wouldn't necessarily account for you to be able to pay that mortgage off.
But like we said, that's just not the case. And for good reason. Canada, at one point prior to the 2008 financial crisis, did allow 40-year amortizations on the A side, on the prime lending side, with even the Bank of Canada in mid-2008 discussing the concerning rise of 40-year mortgages. Soon thereafter, as the financial crisis unfolded in the United States, Canada ended the 40-year amortization period. And, at least on the prime side, we haven't had them since. And as to the reasons why, we can look to the Bank of Canada, who, in 2008, warned that 40-year amortizations allow people to have very little skin in the game, boosting home prices and increasing the risk of correction.
There's no downside.
So the argument was that as homeowners have paid down so little on their home, they have very little skin in the game. They haven't made very many mortgage payments. They don't really own anything, and, as such, are more likely to sell in terms of crisis. Further, at the time, Finance Minister Jim Flaherty noted that their trend towards longer amortizations was of growing concern, and that the government was indeed worried that these longer amortizations were guaranteed by the insurers and thus the taxpayers. And we've talked about this before on this channel. How many of these 40, 50, 60, 70, 80, 90 year mortgages are insured? How many of these mortgages that are seeing these amortizations increase are guaranteed by the taxpayers?
Me, I'm not paying.
And finally, looking back, it wasn't just the Bank of Canada and the government that were concerned over the rise of 40-year mortgages, with even mortgage lenders expressing their support for their demise, with Home Trust asking why get people overextended, and TD Bank saying that the increase in 40-year AMs indicated that people were having a hard time affording their houses. As a side note, and fast forward to today, as of December, 1/4 of the mortgages held by TD had amortizations longer than 35 years, and TD has said that they will allow their clients to extend their mortgages up to 40 years.
Things are different now.
So, 15 years ago, it was decided by the central bank, by the government, by industry insiders, by the banks, that 35, 40-year mortgages, let alone 90, were too risky, and as such, we shouldn't be expecting them to come back to home buyers anytime soon. But that does beg the question, if they're too risky for home buyers, what makes them any less risky for homeowners? Obviously, nobody wants to see anybody have to anticipatorily sell their homes.
I'll leave my card.
But I think this is going to be a question that the powers that be are going to have a very difficult time answering, and a question that those who sat out in 2020 and 2021 and now still can't get into the market due to a lack of supply, due to a lack of listings, due to the banks holding all this risk on their books, are going to continually ask. And that's not even to mention the 60, 70, 80, 90-year mortgages being held on the books by the banks and the inherent risk that that incurs. So I wouldn't be surprised if we started to see more and more nudging, even direction from OSFI, for these banks to start forcing an increase in payments, for these banks to start demanding either a lump sum payment or a major increase in the monthly obligation. While 40 years was deemed to be too risky 15 years ago, I can at least somewhat understand that. It's somewhat reasonable if these banks extend their AMs to 40 years, but I don't think the government or anyone was expecting 70, 80, 90-year amortizations on some of these loans, even when the government did in fact come out with its support for these mortgage extensions. So as the cost of borrowing continues to go up, as these interest rates continue to rise, stay higher for longer, and these amortization periods get longer and longer, don't be surprised if OSFI does in fact step in. With that said, we will continue to track the state of these amortizations and anything that OSFI does on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.